My next guest says he's becoming more convinced that we could get across-the-board tariffs of 15% or so, maybe going up from there on particular countries or goods. Let's bring in Adam Posen, president of the Petersen Institute for International Economics. It's great to have you here. And as Steve was saying, I mean, there's so much uncertainty about how to price this in. What would you say?
Thank you for having me, Kelly. And I think the way to price it in is twofold. First, as the market's already moved so much over the last few months and should have moved earlier, the Fed was never going to do all the cutting that they were pricing in 6 months or 8 months ago. And I think they're still expecting too many cuts. So you can just say on the economic fundamentals, there's no need for that level of cuts. But the second thing is, as you say, on the tariffs, and Governor Waller has his right to, and he has a very good record to argue for what he's looking for. But I think the Fed is making a mistake because the balance of risks, you always have to go on a balance of risks, not wait for certainty. And so they're going to be behind the curve. They're waiting to see where inflation is now instead of where inflation is next. Also, as we just flashed on screen, tariffs are a real income cut. They reduce the availability of goods and the purchasing power of individuals. Take the pharmaceuticals you mentioned. If you start producing them in the U.S., you may produce them in the U.S., but they're going to be more expensive because you have to pay U.S. wages and U.S. plant standards and U.S. intermediate goods to produce things that are usually produced in third world countries because they're cheap to produce. So that's also going to be a source of inflation. Tariffs aren't just the percentage you put up.
So, and it's interesting because you think, well, which one is the goal? Do we want the pharmaceuticals to still be coming from overseas to raise revenue? Let's not talk about by whom, just to raise revenue, period. Or is the point to encourage them here? You get the manufacturing benefit, but consumers have to pay more. The vibe I get from the administration is that they want in the fuller run, perhaps, that the economy is more balanced and has more manufacturing. And if that means consumers are paying more, so be it. The problem is they're already in an inflationary problem. So politically, I don't know how that gives them much breathing room.
I agree with you, but I also just want to, for the record, say not so be it. It's a bad choice. Even if they expand manufacturing, it's not going to make a very big difference to the well-being of the majority of Americans, and it's going to make it harder for the majority of American consumers. So it's bad policy. But even if you, as you say, that the question is what happens now? And I think this hits for both the Trump administration and the Fed. Like Paul Volcker in 1985 had to raise rates a lot, really put the hammer down because they didn't completely kill inflation in 1982. And now we're sitting here and it's, again, the Fed didn't completely kill inflation in 2022 and is coming back on the fundamentals. And so then if you have big deficits, big tariffs, even if it's a one-time price shift, which you and Steve Leisman accurately summarized, and it's a relative shift, the other prices don't go down. So people feel it as inflation. And when you've still got inflation in the system and you're still close to full employment and you're reducing the number of migrants coming in, thereby tightening labor supply, everything's pushing towards higher prices. Again, in theory, it could just be a one-off. But it's a bad gamble for the Fed, especially since, as was demonstrated, companies still have some pricing power.